So we will just wait a few moments for the room to fill up.
So I left the comments so that I can also.
Okay, so good afternoon, everyone. My name is Louise Anninger, and I'm part of Informa Connect. I would like to give you a very warm welcome today to the session. Thank you so much for joining us. We hope that you're as excited as we are for today, where our amazing panel will be discussing risk management, a tool for enhancing agricultural development in Africa. Please feel free to let us know your thoughts and questions in the chat box or the Q&A box, and the panelists will address the questions towards the end. And I would really like to request for you to type your name and your job title before posting your question. If you face any technical issues, please just rejoin the link and you'll be right back with us. So now I would like to hand over to our lovely moderator for today, Rhode Ahlonsou.
Thank you very much, Louise. Good afternoon, good morning, or good evening, everyone, depending on which side of the world you're joining us from. It's a pleasure to see us all connected today to discuss the topic of risk management, a tool for enhancing agricultural development in Africa. And I'm sure many of you have heard the maxim that says, agriculture is one of the most risky places to invest, or financing agriculture is just too risky. And this is because the sector is exposed to several types of risks, going from weather shocks to pricing that is unstable or timely market access, and the risk list goes on, and even government policies that may affect agriculture. And so when we speak about the risks in agriculture, what is risk management in agriculture? And what are the tools that one in the field can use? So thinking of agro-allied operators such as the panelists, the participants we have today, or investors, what are those tools that can be used to enhance agricultural development on the continent, and how can we improve how we manage risks? So to discuss these questions, we have today an experienced panel the panelists have decided to offer the time today in discussing with us. And our panel goes from both the public and private side of agricultural lending. So I mean Unchechukwu Nwachuku, who is a manager of investments at BOI Microfinance Bank. And Uche would be with us today, replacing Azuka Akofu, who couldn't join us for reasons out of control. And we also have Kudzai Gumuyu, who is head of agricultural financing at FCMB Bank. And finally, and closer to the forefront of agriculture production, we have Ayodeji Balogun, CEO of Afex Nigeria. And yeah, this is the panel that we have today. I could go on and on to talk about them. However, for the sake of managing the little time we have together, I'll give them a chance to talk a bit more about themselves as we go through the questions. So let's dive straight in. I'll start with you, Ayodeji, because I know you're closer to production, closer to farmer groups. What are the risks that you see in agriculture, and how do you manage those on the day-to-day? And by the way, you can tell us a little bit how in your work you interact with those risks in agriculture.
Thank you very much, Rhode. Great to be here this afternoon. So at FX Commodities Exchange, we're focused on two core deliverables. So one problem that we try to solve is to ease the flow of commodities from the producers to the processors. So we really take it from what should the farmer be farming, when should they be farming, how does it raise the money to farm, what quality, where is it aggregated, and how does that product get into the final user of the commodity in a way that is traceable and that the value created is shared fairly between them. The other part is to then ensure that both the producer, the processor, both have the liquidity to be able to buy the products or produce optimally. So we work with financial institutions, we work with capital market players to unlock liquidity by creating these transactions into investable assets that they can then invest against. Now, again, if our job is to tell somebody to put his money as part of this value chain, then it's our primary responsibility to create structures that can then ensure that some of these risks are managed. So when we look at the work that we do with farmers, we dimension the risk across sort of like 4 different elements. So first is the production risk, things that, then we look at things that are induced around climatic patterns, around the quality of the inputs that the farmer use and the readiness of that for the market. So somebody needs soybeans, but they could need either a fat heavy or a fat low soybeans variety. And if you mix out the variety, it could be off the market by quite a huge discount. Also looking at different, how to then manage those things. So in one of the things that we've done is around insurance products that we have. And this year also around managing the health crisis of the farmer. The health of the farmer becomes one of the challenges we have in a year like this. So in our insurance products for the farmers this year, we have an health and life component that ensures that if they do fall sick, including COVID, then they have a recourse to an insurance product that then pays for their health. The other parts of the risk where we look at is around the storage and handling. Grains, for instance, we lose about 14 to 15% of grains due to storage and post-harvest losses. In fact, this is massive, considering that Nigeria produces about 30 million metric tons. So 14% of that is about 5 million metric. So that's a very large part of what we produce that goes to waste, about 500,000 metric tons. Now, the other part is the market. So the market risk, one is availability of buyers as at when the seller wants to sell. The other part of that is the price risk, which is around what price is the person selling or what price is the person buying, and how does that match their cash flow projections for the year. So as a commodities exchange, being able to provide solutions that manage the market and the price risk is our primary core focus. And we do this for using several tools for both the producer and the processor. So on one side, we have issues around well-specific financing. We have trade finance solutions for the buyers that we work with. Also, farmers can get a forward contract that allows them sell their grains 3 months ahead at a fixed price, and then they just deliver it into a warehouse. And on delivery dates, then the settlement happens and they get part of the cash immediately, and then they get the remaining at the forward strike date. There are also some value chain solutions where you have some corporates that are tied backwards into certain value chains and ensure that because they are part of this, they either get a premium price or they get a guaranteed price from the off-taker. We do work, we work with Dangote on the rice project. Over 85% of the farmers under the Dangote rice project scheme, farmers we work with. We also work with Diageo and some other corporates with an integrated value chain where they know the traceability, the sustainability, the productivity of all the farmers that produce the food. On the last one, where we also look at what policy can do. So there is the Strategic Grain Reserve, Department of the Federal Ministry of Agriculture, and they are part of what their primary focus is to do is to provide, be the buyer of last resort for the country, but also provide a guaranteed minimum price. So that they ensure that when there are issues around market liquidity or prices, they come in as an agency of government to step in and reduce this risk. So that's what we've done, and what we've also seen in the landscape around risks and then how they can be managed.
Thank you very much. This is useful. I think you've given us the full spectrum of along agricultural production and distribution value chains, what are the different bricks and how you cope with those. I'll step now on the financial of things, and starting with you, Uche. I think from the work you do at the microfinance, what are the risks that you see from a microfinance perspective? And how do you manage those risks?
Yeah, thanks, Ruth. I mean, what we are talking about here, there are three key components: risk management, and agricultural risk management. And in terms of risk, they are similar, really. Risk refers to any event that has the capability of distorting the business of any enterprise, be it agro or not. And when we're talking about agricultural risk management, we're now looking at innovative solutions to help build the resilience of farmers, agribusiness owners, and other entrepreneurs that play in the agribusiness space. At the Bank of Industry, we understand that for the most part, if you're coming to take a facility in Nigeria anywhere, those facilities. Those what we call more or less at the bottom of the pyramid, or those playing at the lower level of the agribusiness space, even those at the commercial level. You understand too that they might not always readily have the collateral or the security to provide, to be able to access these facilities. So we more or less have to come up with innovative means to try to encourage, to be able to enable them to take these facilities. And what happens is we have established a group we call more or less business development service providers, BDSPs, those that actually work directly with these, be they farmers, be they processors, be they distributors, no matter where you are in the value chain, to help you sort more or less through the noise or through the chaos of what is happening in the industry and find out ways you can better access the facility at BOI. Just taking it back a bit, when I'm talking about agri-risk management, in the value chain of agriculture as a whole, we can talk of producers, processors, and maybe distributors, but we also have suppliers, we also have financiers, regulators. These are all the people that play in the agro space. And once there's a risk that affects even a single one of them, it distorts the entire spectrum of the agribusiness space. Like Ayodeji said earlier, there are different risks that can happen. It can occur at the production level, it can be weather risk, it can be financial, it can be market, it can be human risk, it can even be legal or government policy. I want to touch a bit more on government policy risk. When I'm talking about this is, number one, I currently work with a government-owned bank. And secondly, I've also had experience at the level of government policy provision. Because despite your best designs as a private entrepreneur or farmer, a government policy in a day can change your whole business spectrum. Take, for example, the government can come in there and decide that no more importation of milk or dairy products. If you're a farmer, a processor that depends on dairy products, you're almost immediately put out of business. And this is what happens, or what is very prevalent in Nigeria. The cause of this is lack of what I would call situation analysis. So for the farmers out there, or for those that are involved in the agribusiness space, there are two ways I think resilience can be built in the industry. One has to do with the section of the farmers, the business, the community, and one has to do with the government policy. Now, what we can affect is the one that has to do with the farmers, the agri community, and the cluster of farmers. The one that has to do with government, the most you can do is to form pressure groups or try to nudge the government towards the area of trying to provide some of these assistance to the farmers and the other businesses. When we are talking about what farmers or communities more or less better their lot when it comes to building resilience, first is, do they have the financial knowledge or skills required to play in the industry? This is a key risk. This is a key risk in terms of if you are intending to access a facility from a bank like BOI or any other bank, you need to show consistency, you need to show that your books are clean, you need to show that you know what you are doing. Do they have this skill to be able to keep their books in order, never to even be able to access these facilities in the first place? Secondly, do they partake in things like goal setting? Do you have a target? Can you forecast? Because for somebody to be able to give you a facility without appropriate backing, you need to be able to show reasonable forecasting of what you are going to get in return to be able to pay it back. Again, we're looking at things like, do you have farm management skills? Do you understand financial risk? And what are your operational expenses like, as well as marketing and your marketing plan? In terms of government, what is required at the government
Okay,
level
I think
is
for knowing that the time that we have is little, and then we'll open up to Q&A, I'll say if you can wrap up in 30 seconds, and then we'll hear Kudzai's
wrap up
thoughts
in
as well.
30 seconds. For government,
Yeah.
what we need clearly is situation analysis, because things like risk, like weather risk or some other production risk and input risk, there's nothing the farmer can do about it. But they need to provide facilities and amenities that will be able to help ameliorate some of these risks when it comes up to the farmers. I'll wait for Q&A to be able to present more. Thank you.
Thank you so much, Uche. So I'm hearing two things in addition to what Ayodeji has said so far, which is that in addition to the agricultural value chains, there are also other players alongside the supply chain or who are not typically in the value chain, but who are also terribly affected by agricultural risks. And I've also heard some of the ways that as a bank, you also taking steps to cover for the client that you're serving. And so going with Kudzai, I'd love to hear, I know that from FCMB Bank, you may work with relatively larger businesses to those that microfinances work with. Are the risks that you see similar to what Uche has already said? Is there anything you add to those risks? And
thank you.
So great to.
Thank you.
Please go ahead, Kudzai.
Yeah, I think before I go to the exact risks that are there, the topic is saying risk management, a tool enhancing agricultural development in Africa. As far as I'm concerned, no development goes or happens without investment. So whatever we are doing in terms of risk management that enables development is to making sure that whoever is investing in agriculture is making a profit. Because anyone who doesn't make a profit and makes a loss, they usually stop investing in that business. And agriculture has to be profitable for anyone who invests in it. The impact of risk on a business is that if it's not managed, it results in losses. And losses actually threaten the very existence of the business. And we know capital is timid and it flees at the appearance or rumor of risk. And also there's an opportunity cost for someone who would have invested in agribusiness, or they could have taken their money elsewhere. Therefore, having said that, we see that there are lots of risks that are associated with agriculture, be it political risk. If a country is unstable, people investing in that country, it becomes a bit of a challenge. Economic risk, if there is massive inflation or there's devaluation, external investors might not be actually keen to invest in such an environment. And we need to make sure that businesses make profit. And profit is actually a lubricant that reduces the friction or resistance to investment. You cannot eliminate risks, but you can manage risk and reduce in a way that actually encourage investment so that people make a profit in it. So from where I sit in the financial services sector, it's we actually finance agriculture. And when we finance agriculture, the bank is not a charity organization. It has to get a return on so it means the The money that we give you, the principal, as well as the interest that we charge, should be coming back to us, and we shouldn't make a loss. And we have a number of risks that people have talked about. If it's a farmer, you're giving money to a farmer, there's the climatic risk where there could be a drought or a flood that can damage crops, or even the farmer is harvested, the crops can be damaged before they are sold, which is post-harvest losses. And as a bank, we are seeing a situation where we are coming with some solutions, innovation solutions that have got to do with mitigating the risks. And when you mitigate the risk, if the bank makes money, the farmer makes money, the traders and everyone within that value chain or the ecosystem makes money, you find that there will be a lot more investment into agriculture. And when you have a lot more investment into agriculture, you develop the country. It becomes a tool of economic development. And
I wonder if you can tell us a bit about, like, who do you partner with in managing your risk from a bank perspective? And other things that you do, like going to the farm, checking on what is happening. It'd be useful to hear a bit of that.
Yeah, that's the day-to-day management of the risk, where you have to monitor. After you've given out the money, you have to monitor. So you've got relationship managers that go and meet with clients, checking implementation, checking whether the plans that the person who wanted to implement are actually being implemented in the right way. You also have, if you are financing commodities, you've got collateral managers who come in to check on the quantity that you have financed. You also have like domiciliation, where if you have financed someone and they've harvested, if they are selling, they need to sell to someone who is who can deposit directly into their account. Otherwise, money is fungible. You might finance, and at the end of the day, they take the money and use it elsewhere. So what the bank needs to manage is default risk. If you manage default risk and you've got very low non-performing loans, you find that the bank will be more and more keen to invest in that sector. And that will lead to development. So monitoring is one key thing that you've got to do. And also the assessment of the risk. When a farmer or an agribusiness brings a request for a loan, those assessment tools that you use to see the health of the business and the repayment prospects, if you manage that approval process, you actually manage 75% of the risk if you do it well. So when you do that, you find that the bank or any financial institution becomes more and more profitable. And when it's profitable, it will actually invest more into the sector.
Thank you very much, Kudai. It's interesting to now see, as a bank and the other agro-allied operators in the, among our attendees today. And it's useful to hear that you're also not just helping farmers to avoid those losses, but as a bank, you're also managing your risk. And maybe to go a bit deeper on the agriculture side of things, we know that agriculture is a diverse field. And in some of the studies we've done at Dalberg, we've looked at various agricultural crops. And it's clear that the risk that you face depending on the risk that you're looking at, not all agricultural crops are prone to the same type of risks. And so when you think about the differences in agricultural value chains, do you see, what is your approach to investing or supporting a particular value chain? Would you rather hedge your bets on those that are less risky versus more risky? Knowing that no pain, no gain, but how do you hedge your risk around those that are more risky versus those that are not. And I'd love to hear your thoughts on that, Ayodeji, and then others can chime in if you have additional points.
Yeah, thanks. So when I look at the commodities, I typically like to dimension them around staple and cash crops. So because when you look at it, then it helps. So, but within the staple clause category, now again, before, just to put a caveat, so I'll say perishables, staples, and cash crops. Now, perishables have a very they're very time bound and have very high transit risks. So you have to be able to then look at things around what is the quality assurance between the point to the point, and are you sure that you can consummate and close the trade and get it into a conditioned room within those time period. Again, as AFEX, we don't focus on perishables, we focus on more stable commodities and then the export side. Now, between the export and the staple crops, one very unique difference is the value. So 1 metric ton of cocoa is worth about 10 metric tons of maize. So for every 10 trucks of maize that go, it's equivalent of 1 metric tons of cocoa. And that has a huge dimension around how it goes on the trade side, the risk, the goods and transit insurance, the professional indemnity, public fidelity insurances that you need to have for any warehouse that is storing those products, and then the nature of your collateral management agreements. If you are having working with financial institutions or the banks, a lot of banks, trade finance is not something that is quite robust. Kodzai on the call is one of the leaders, thought leaders in this space today. But then if you look at it from an angle of collateral management, there are actually 3 types of agreements under broadly described as collateral management, and the 3 of them have different implications on risk and the recourse you have if there are incidences that happen. So having that level of understanding will be extremely important, especially if you're doing something in the cash crops. Now, on the production side for staple, one major risk for that production crops have, that cash crops or export crops don't have, is consumption or side trade. So if you're growing cotton or cocoa, the farmers don't consume those crops. So they are almost obliged to sell to you or to somebody else. So if you are there with the right price and you have your logistics solutions working, you have a good chance of being able to absorb it and then pay them back. But for the grains and for the food crops, the staples, primarily they also want to consume it and feed their family and their household. So it's when they then get yields that exceed all of those needs that they then start to consider the repayment and then this eventual selling into the value chain. So yes, I wouldn't say there's a major difference that is not agronomy related between maize and soybeans or between rice and maize. I think within those sort of frameworks, you could classify staples as one and then treat it. You could classify cash crops differently. You could classify perishables differently. The other dimension to it is now geography. So depending on where you are, you could have significant risk. So if you are in the southern part of the country where it rains about 10 to 11 months, moisture and humidity is a big concern for you, versus if you're operating in the northern part of the country. If you're in the northeast versus the northwest, then security then becomes another thing you have to then start to consider, and then the cost of logistics and things like that. So it's pretty much a dynamic principle, but certain frameworks can help you dimension and then manage them quite well.
Thank you, Ayodeji. And Kudzai, Deji just called on you on your role in this field, and I'd love to hear if there's anything you will add from a banker perspective, if there are some sectors that are more attractive to you to invest in versus others.
As a bank, yes, there could be sectors that are attractive to invest in because of some high returns. But as a banker, what I look at is the specific business. Is that specific business viable? Because you could have a business that's making billions in the same industry, the same, another company is making billions in losses. And the two differences will be management. So for me, I know currently there is a lot that's happening. People say oil palm, people are making money. Some export crops, people are making money. But I usually as bank, I should be looking at sectors per se, but I actually look at the specific business and the specific management that's running that business. Well, that determines whether I'm going to be paid back my money or not. But in Nigeria, a lot is happening. If you look at the grain crops, maize and rice, if you get those right, it's a profitable business. Oil palm, it's a profitable business. But I wouldn't want to generalize, because people in the oil palm business, some are making losses. People in the maize value chain, some are making losses. So it really borders down on the management aspect of the business.
That's great to hear. So yeah, it's interesting. So I think Ayodeji, you've told us that it's useful to understand the angles. Once you've been able to split and understand whether you're dealing with cash crops versus staple crops and understanding the risks to deal within that, what Kudza is telling us is that you want to invest based on what the management of the company actually tells you. And that understanding of the separation of crops is, of course, useful in how you approach it. I'd love to hear, Uche, if you have, do you have any additional points to make on this?
Yes, very quickly. Again, what we are talking about here is more or less enabling agricultural development in Africa. And in Africa, we're always quick to focus on production. And what happens is that some of those staple crops we have, like cocoa, cotton, we export raw materials where developed countries process them and sell back to us at a much improved price. So what BOI actually focuses on is on processing and manufacturing, which is the value adding stage of the agribusiness, and it's not exclusive. And what we try to do is try to find ways to enable processors to take it from stage 1 to stage 2, add that value, of which you can export something that has much more value to developed countries, or even sell within local countries. So what are we doing in this field in terms of enabling processors to be better? First, we try to encourage them to deploy in clusters. I'll give a very quick example with the Dangote tomato plant that is in Kano. They had to shut down for a while because there was an absence of raw inputs. And you find out that what happens is, if you carry out appropriate situation analysis, you find out what is required for you to be able to deploy in any cluster. Do you have the direct raw material? Do you have access to what is needed? Do you have access to markets? And we try to encourage processors to make sure that when they're deploying, you cannot be in Onitsha and say you want to be a processor of tomato that is mostly grown in the north. It doesn't happen that way. So we encourage you, if you're either situated in a place where you can process the raw materials directly, or you're able to find linkages that will be able to help you to do that. Secondly, we also try to encourage outgrower programs in terms of finding solutions whereby the processor, the producer, possibly distributors come together as a group and find ways to mitigate the risks that might be a burden on each other. When the producer is guaranteed of 100% uptake from the processor, and the processor is guaranteed of 100% uptake from the distributor, you see that the risk is very much mitigated at all levels of the value chain, and it makes things much easier to do. Finally, also, there are government policies that are everywhere: CBN, NISA, BOI, even at the federal level, giving palliatives and set several other things to people that play in the agro value chain that you can take advantage of to be able to mitigate your risk if you're an agribusiness owner. I hope these have helped.
Thank you very much. It seems interesting to hear that it's not just at the crop level, when you go to the processing level, many of the things that happen upstream actually affect the amount of risk that you as a banker or as a processor or as an investor in agriculture need to keep in mind. To allow some time, we do have some time to address Q&A, and I'm starting to receive some questions from the audience. I'd like to, however, touch on one final question, and then we open it up to Q&A. If you can, I think if each panelist here can tell us, from what you're seeing in agricultural risk management so far, what is that one big idea that you think could revolutionize the way we approach risk management in agriculture and can get to better outcomes for the continent? What is that one big crazy idea? Perhaps you haven't felt as comfortable to put it on because you think it might be against what conventional wisdom is, or it's just something that we haven't thought about too much and it might be close to our fields of operation. What is that one big idea that you will share with us? And let me start with Kudzai.
Yeah, for me, what I see basically, which is really impacting and dragging Africa backwards, is the land tenure system. Africa, most of the land, it's not owned, it's communal, and the farmers, especially smallholder farmers, don't own any land. If you give or you enable the smallholder farmer to have title to their land, and they can take that title and be able to borrow money and raise capital to develop their farms, I think we can see a revolution in terms of agricultural production in Africa. The whole of Africa, mostly, I think with the exception of Rwanda, which is actually now doing that, to make sure farmers own title to their land. There will be very minimal investment because they don't have title to the land. You could develop it and someone can come the next day and say, get out of here. So for me, we need to change the land tenure system in Africa to enable farmers to develop wherever they are and raise capital to develop their farms, develop irrigation and develop all the other things. If that gives them comfort, it actually reduces the risk where someone can say, I will not invest in farming and I will invest elsewhere. Because money has got an opportunity, because if farmers become more comfortable and they are more confident that they own the land, investment will come there. And I believe there will be massive development in Africa.
Thank you so much. Ayodeji, what are your thoughts?
Yeah, thank you. It's interesting the way you put it, Rhode. So I actually had one thing here, quite crazy, but I believe very strongly in it. And when I was reading my list, I got to that word and I let it out. So yes,
exactly what I was looking for.
Exactly. So again, if you look at how commodities are traded or agricultural products are traded all over the world, there's no way where you actually do go to the market and you buy what you need this week today. Everybody trades futures. Everybody buys their commodity ahead of time and locks in the prices and then gets it delivered at the time when they need it. So it helps planning. It takes out price volatility. It helps numb the market. You still have some surges up and down, but then it sort of evens out the market. We need to get our market structured. We need to get away from the point where if I'm a feed mill and then, so look at the last maize crisis and the recipient's position, right? We're at the point where we are towards the peak of the season and 3 months to the next crop year. And then, poultry mills are saying, we don't have the maize we will use next month. We have to go and import. First, on one side, if you go and import, it will take about 100 days for those grades to get into the country. Second is, why are you in a situation where you've not locked up the price, you've not locked up your commitment for the year, you've not locked down the products, you've not hedged your price risk? So again, if we really want to get Africa to par and we really want to drive agro-industrialization, I really think it's high time we really do things and start to build a structured futures market for commodities. It will be a journey. It will take about 10 years. But if we don't start now, then it's 10 years plus one. So that's my crazy idea.
Lovely. Thank you, IODG. And I'll say, I'll come back to these ideas shortly, but I'd love to hear, Uche, do you agree with the two ideas from, I'm hearing some echo on the line, but do you agree with the two ideas from Deji and, okay, just checking. I think you can go ahead, Uche.
Can you hear me now? Can you hear me now?
Yeah, we do.
Okay, yeah, for me, what I think will actually help is
There's an echo on your line, Uche.
just to be so. Can you hear me now?
Yes.
Okay, what will help revolutionize really agriculture and help manage risk in Nigeria is what I like to call modular clustering in the cottage industry. And what do I mean by this? Most times in Nigeria, what we are dealing with are smallholder farmers, and there is lack of mechanization. While on the other end, we have high-end industries that have capacity, but they just don't have the inputs to be able to sustain them. So if we're able to build this system whereby there are clusters of producers, processors, and off-takers within small range areas, and be able to scale it to different sectors, different agricultural levels in Nigeria, that will actually help for Nigeria in particular, boost production, boost processing, and invariably help develop agriculture in both Nigeria and Africa as a continent.
Great. So there we have it. Speaking of agriculture and risk management and how we can mitigate against those, we've seen that there are various types of risks across the value chain, and the way you need to understand those risks would differ whether you're speaking of staple versus cash crops, and the way businesses are managed would influence a lot how you can how you manage the risks in agriculture. And I think we haven't figured out yet, and we're still a bit backwards in the way agriculture operates on the continent today. Yet there are some big ideas that are coming out from this panel, going from really the basic point of land systems at the farmer level to secure the investment you're making, to the idea from Uche, which is more thinking about the smaller businesses and how do you create clusters around them to help them improve their productivity and therefore returns for investments. And finally, IODG's point around structuring markets and being much more planned ahead in terms of how different stakeholders think of operating and getting input on the market. So I'd love to pause on this note at the moment and then open for Q&A. We have a bunch of questions and I'll be filtering according to those I think we have, the panel has addressed already. But the first question is from Samson Oguntoye, and his question goes as this. As part of risk management, what criteria or guarantees do you look out for when selecting input suppliers for farmers? I'll say that again. So when selecting input suppliers for farmers, what criteria of guarantees do you look out for? I think that would go well with what you do, IODG. Do you have any reaction to that question?
Yeah, when you look at guarantees, unfortunately, we are at a point in this market where our input providers do come with guarantees. You could get insurance layers on top. We've seen a few examples of where you have an insurance product embedded in fertilizer, for instance. In other markets, they actually come with seeds, which then says that whatever happens, both between the seed company and the insurance company, the risk is covered. So we've not seen a lot of that in this market. But then if you are, managing an agro scheme or you have a large farm, the first thing you want to know is, what does my buyer want? The second is, what works best in this geography. So it's not, we've gone past the years where it's one single fertilizer blend for the whole country. You need to adapt it for the crop and for the location where you are. And the third is just the agronomy. So sometimes, just being able to switch from cereals to legumes and back to cereals helps you drive up productivity by 10 to 15%.
Thank you so much. So I think we have another question, and also one of the participants from New South, Mr. Baba Robert, who has, he wants to, I think he provided some questions to the organizers. Louise, while you look for that, I'll go to another question. But basically, Mr. Baba Robert has sent some questions outside of this channel ahead of the webinar that would be lovely to come back to and address. And from Eve Komaklo, it is an input saying that it's essential to distinguish between staple and cash crops, and it is also important to look at exchange traded commodities versus those that are not traded, because they allow for prevalence of market price and usage of risk management instruments. I think those are contributions, and looking for whether we have other questions. So yeah, question from Mr. Tobe Lekan. Are risk management strategies used for crops different from those used for livestock when assessing finance from banks? Kudza, I think that would be for you. So difference between managing risk for crops versus in livestock when you think about financing.
Yeah, I'll still go back to what I said. A bank, when they are financing anything, be it a crop, be it industry, what they are looking at is, if I give you my money, is it going to come back principal plus interest? And that comes out of a profit. So whether you are in poultry, as a banker, when I assess the risk on a poultry, I'm going back to the fact that, are you going to pay back? So in as much as I look at poultry, and there are certain things that I look at. For instance, if I'm looking at broiler production, I'm looking at which breed are they buying, what is the mortality rate that the farmer has achieved before, do they slaughter on their own or they sell to somebody else, at what price are they going to sell, and when they sell, is it viable, where are they getting the feed from, are they not going to run out of the feed, what systems have they put to make sure that they are able to take the bird from day-old chick until it's slaughtered. Those things might be different from, let's say, a maize farmer whom I'm looking at. Do they have tillage services? Do they have the right seeds? Do they have fertilizer? Do they have the management on the ground to actually be able to plant a crop and harvest it? Which area are they in? Is it not an area where it could be drought prone and they could lose the crop? Or is it not an area where it can flood and they could lose crops? Like these days, there are lots of risks. Are they in an area that can be prone to locust invasion? All those things come into play. And as a bank, I'm now going to say, can I insure against the risks that I see that are more prevalent, like droughts and floods? You could insure. And when I insure, I'm assured that even if the farmer fails, my money will be paid back plus interest. Even on the poultry side, if there is bird flu that comes in, is the farmer insured against that bird flu? if that happens, am I going to be paid? And do they have the right, what can I say, bio safety issues or bio safety where disease cannot go into the farm? Do they implement all those things? So for me, those are the things that can be different between animal production and crop production. But as I said, all I'm actually looking at is, will the farmer or will the agribusiness be able to pay back the principal plus interest that I have given out?
Yeah, okay, that's lovely. I'll go to a question from Mr. Amadou Nikema, who is sharing an experience from Burkina Faso, where a local agricultural insurance company, Sona, has partnered with the government to provide insurance, agricultural insurance for farmers, and at a quite affordable rate at a $11 per hectare for a maximum compensation of about $230,000. And his question is, what do you think of the Association of States insurers with financial institutions to find solutions to control risk? I'll direct that question to you, Uche. It's basically looking at how do financial institutions, governments, and insurers can come together to control risk in agriculture. Do you have any perspectives on that?
Yes, what actually happens for a country like Nigeria, generally there is debt of insurance. There's not a lot of insurance even within areas you have physical assets. And insurers, they're more or less, they're supposed to take away your risk. And things like farming, it's quite relatively unpredictable in terms of some of the risks that might happen, like production risks, climate, weather, and all that. So to manage this risk, again, the easiest way for it be for those that do not typically have collateral or those that might not be able to access these insurance companies or financial institutions is to come as groups. Now you can come as groups in different ways. First is a group of people doing similar stuff in terms of maybe a group of farmers, maybe 100 farmers, direct producers in an area, coming together to access credit or to access insurance for your cluster of farms. You can also come in terms of a group of different people at the various levels of the value chain, which is what agencies like the CBN, TNISA, and all that are trying to do now. In terms of you have farmers in a particular cluster with a particular processor that has agreed to uptake all their producers, and they have linkages with distributors. This is another way of mitigating risk and being able to transfer it to another level. And for the third part, the government is actually doing a lot trying to take away some of these risks. I know that there are some financing, like they've asked the government agencies like BOI, once the farmer or once the processor or once the person can bring 50% of the financing, the government will insure 50% of it. So these are some of the areas that are currently being explored in Nigeria, and I believe some other African countries have flexibility in what they're doing right now.
Rhode, I think you're muted.
Oops, okay. I was just saying, Uche, that the next question is also for you. And speaking to the fact that you work mostly with micro enterprises and smaller companies who are the majority of the players in agriculture field in Africa. And as you provide loans to them, we also know that the rates of microfinance banks are way much higher than banks and other institutions. How do you think we can bridge those gaps? That gap of the smaller players, they are the ones that are most in need, yet insurance is, the cost of lending is too high for them. How do we bridge that gap?
Unfortunately, in the banking industry, the higher your risk, the higher the premium you are asked for. And most of the times, these smallholder farmers, they come with really huge risk because, to be honest, a typical bank, no matter whether it's a development bank or a commercial bank, they do not want you to use staple products as your collateral because they're either, irrespective of the fact that they are mostly perishable, usually they do not even want to keep it in their stock, and they're not in the business of selling crops. They're in business of providing financing. So if you are not bringing any reasonable collateral, understandably, your premium will be higher. However, there are several things that can be done. What is done in BOI is that we encourage people to be repeat customers. So if you take the first time, next time you are taking, you are guaranteed to get a lower interest rate. Next time you come, you continue getting lower interest rate, encourage you to come back. It's a good way. So you find out that if the farmer or the producer or whoever it is comes and takes the first one and repays as an outward due, he's already showing track record of being able to repay a loan. So next time we encourage to give you at a lower interest rate, knowing that you're going to make good on whatever debt you collect. Secondly, I will encourage them, especially those in Nigeria, to keep a key eye on the federal government. The federal government, through the Federal Ministry of Agriculture and Rural Development, as well as the CBN, they have tons of palliatives for farmers. The administration of President Muhammad Buhari, he has special interest and special emphasis on farming. So they have so many palliatives that you can literally take advantage of. One of the key ones is the agro-grower program that happened that in rice sector, there are things happening in cotton sector, there are things happening in tomato sector. So in a situation whereby you cannot get a more favorable credit facility than you would like, you should also look at government palliatives to be able to bridge the gap between what you can afford and what you cannot.
Thank you. Then we have another question. I think this one can go to Ayodeji, and the question is from Mr. Oji Ihiani, and he says, what is the best standard? What is the international best standard in managing agricultural risk? Is it by insurance or just by adapting to good agricultural practices?
Both. You can't insure without doing what you need to do. I mean, the insurance wouldn't take all the claims if you've not done your part. So I don't think it's one or the other. Definitely, you have to follow good agricultural practices. And then on top of that, you then insure.
Yep, absolutely. And then I'll take this one to Kudzai. And the question is the fact that irrigation and control environment agriculture is virtually inaccessible to smallholder farmers to mitigate risks. What innovation would you advise to mitigate that critical risk that virtually limits the productivity or the possibility for smallholders to grow?
Yeah, I wouldn't say they are non-existent. There's a lot that's happening now, especially with solar power irrigation, where there are small pumps. You can drill a borehole, you can take water from a river, and you can irrigate, and thereby improving yields and also guaranteeing some yields. It comes at a price, and if we can have some risk mitigation, banks can actually finance those acquisitions. But in the absence of all that, you can also come in with a number of intervention. One of the intervention is insurance against droughts, against floods. The other one is, as a bank, there are some NGOs who can come in, and development partners who can come in and do what is called credit guarantees or risk sharing arrangements. NISAL is one of them, and there are lots of other companies that are actually in that field. So those things actually enable smallholder farmers to get finance. But there's also the outgrower model, which Deji is running, and a number of other innovative companies that are actually changing the face of agriculture in Africa, where the farmer cannot approach the bank on their own, but they can piggyback on an aggregator or a processor. That processor borrows money on their behalf and then buys chemicals, fertilizer in bulk and distribute to the farmers at a much cheaper price than if the farmer were going to buy on their own. And when they do that, it reduces their costs. They are guaranteed of a market, and they get extension services. They also get storage services, which means post-harvest losses are being reduced. So the farmer has got access to inputs, because access to finance, they want to buy inputs, that they want. So if you do that, and we are seeing a lot of successes in this field, you will be able to develop farmers, and farmers will be able to access finance, and they'll be able to be more productive. So those models need to be promoted and need to be scaled up so that more farmers can be reached, and there is more productivity.
Amazing. Thank you, Kudzai. It's clear that avoiding the risk in agriculture can be tricky, but there are ways that we can work around it, and working with different partners in the field. And it's useful the way you've played that out. And the next question is for you, Deji. The question is from, I'm trying to read the name. I don't think okay, it was Anonymous. I'm hearing some background noise on the line. So this was from an anonymous participant who says that one of the restrictions for exports of agricultural products from African countries are some of the conditions and restrictions placed by foreign countries under the guise of grading and standardization. And don't we think we need for Africa to establish a central grading and standardization agency for agricultural commodities in order to challenge the difficulties faced by agri-exporters? What do you think, Deji? Do you think this is feasible? No, we are exporting to buyers who have their own standards.
So first, I agree that Africa needs to have its own selfish agenda when it comes to international trade. You know, things around line of credit, things around pricing. You know, things around like fair share of value to the farmer. So for those, I am all for. When it comes to quality standards, so the first thing is when you're trading, there's always an agreed specification. So you could reference an international specification, or you could, for that contract, list what the quality parameters will be and the ones that are accepted to that transaction. And in that case, that's what is binding. So I think it's the problem is not so much about who is adjudicating on, is it this quality versus this quality? Because if you want it, you actually have inspection agencies that are private, independent, and can do this inspection right from here. I think the bigger problem is that we really need to look at our value chains and say, do the food products we do sell, do they meet human consumption standards? Do they meet the minimum levels? What are the Salmonella infestation levels? What are the aflatoxin infestation levels? Honestly, I think we need to do a lot more.
If you can go on mute.
We need to do a lot more work from us, and less on what the buyers are saying. I think there's a lot of work we could do. And to consider that what we export is actually higher quality than what we consume. and then what we then export gets rejected. Then what we consume typically in Africa is even of a lower quality than what we export. So we indeed have a bigger problem than even the trade angle.
Yeah, absolutely. And these are some of the issues that, as we think about risk management, it might be useful to also shift gears in terms of the countries we are exporting towards. And if we can't meet the standards of some types of countries, are there others who have lower standards? And I think if you switch gears that way, it also comes with the pricing. And one example is that we've seen from past work in Dalberg is European, when you take example of fresh fruits and vegetables, European countries have much more stringent standards, whereas the Middle East countries have less stringent standards, but they also offer lower prices. So there's also that aspect of market that we're targeting for different products. So going next, I'll ask Louise if we can unmute Mr. Baba Robert, who wanted to share, contribute on what he sees in risk management perspectives, having collaborated with investors, insurance providers, and the NEOSAL, which Kudzai just referred to. Is it possible, Louise, to unmute Mr. Baba Robert? Okay, so while the organizers figure that out, I'll see if we have any other question to address. Okay, so I think we've seen a few questions around working together with government to deal with the issue of agricultural risk management, and the example around government partnering with insurance providers, and we've seen the role or the work NEOSAL has been doing in Nigeria. But I'd love to hear from each of you in the panel. So if you do have the president of Nigeria, or you have some key policy makers or decision makers in the room today that you would like to speak to, what would be that one thing that you think policymakers can do to ease the work for agricultural risk management from your perspective? I'll start with Uche. I know you're closer to government, and we'd love to hear what are those things that you think can be done, and then we'll move on to the others. And Uche, you're in mute.
Okay, yeah, I totally agree with you. All the major agro-producing countries, be it China, be it US, be it even in Europe, they have very high level of government involvement in the private agricultural sector, because the sector needs critical government intervention to succeed. So coming down to Nigeria, what can the government do to be able to better this lot? First thing first, the government is actually doing quite a few things already, but there's a big difference between design and implementation. So all the good plans we've had over the years, be it the agro program, NISAL, and some of these other agencies, they've not been implemented properly. Other countries have successfully implemented these things and are working for those countries. Why do they not work in Nigeria? The problem arises in people generally taking anything that comes from government as free, and there's no interest in repaying or doing it professionally or that. So the government might want to pay more attention into getting professionals to be able to deliver some of these their programs. Secondly, the government usually has a funny approach to enabling stuff in Nigeria. Things like, okay, we want to grow the tomato industry. We ban the importation of raw tomato in the country immediately. You don't have the capacity to produce it. Why are you doing outright banning? You can do import substitution. You can gradually enable people that are in that sector to produce enough for you to be able to go to that extreme. So what happens is that when you actually ban importation of some of these products, it creates another avenue for smugglers because people must consume. It creates another avenue for these smugglers who now drive the prices higher, make the market more volatile, and is no longer efficient. Thirdly, the government can actually help in terms of creating these clusters that I've spoken about frequently, because this is where the government comes into play. Individuals cannot do that. Individuals, there's a restriction, there's a level to what they can do, but it's only the government that will be able to create enabling environment in terms of saying, okay, within this canoe sector, we'll call it the leather sector, within KB sector, it's going to be the tomato sector, on the people, you can focus on this. And when you create those clusters, give them the relevant inputs in terms of raw materials, mechanization, professional quality assurance, and all that. And you help them to grow together as a cluster. And these are some of the things I think the government can do to enable agriculture in the country.
Thank you. What do you think, Kudzai? Kudzai, if you're still on the
Hello?
line. Yeah.
Sorry, I was muted. Right, I believe the government should come in as an enabler, policy-wise, and making sure resources are available for the private sector to do business in a less risky manner. If government can guarantee profitability of agribusinesses, I believe you will have reduced a lot in terms of the risks. And for me, if you reduce the risk, you enable investment and you enable development. Specifically for Nigeria, I think the government is doing a lot already with intervention funds from CBN, with risk sharing arrangements from NISA, from this central bank itself. Those things are happening. And I believe the other thing that the government needs to be doing now is to looking at empowering the smallholder farmers through a land tenure system that enables them to approach banks on their own. The moment you do that, you empower them and they'll be able to invest on their farms. So those are the things that I feel can be done. I know it's not an easy thing. It's very difficult, but it's one thing that makes Africa different from the rest of the world, because most of the countries, the farmers actually own the land that they have, and they are able to approach banks and borrow. But in Africa, it's not like that in most cases. So those are the things that I feel Africa needs to look at so that we de-risk investing in agriculture.
Great. And Ayodeji, what is that one thing that you love policymakers to address for your crazy idea, for example, to get implemented?
Okay, so so again, just before I come on the futures market, so I'll touch on Kudzai's point around the risking. So agriculture is 10 times, it's perceived to be 10 times riskier than it is. If you have a good operations, you will see that between 3 to 8% is the default that you see in a good outgrower scheme for primary farmers. But then people think that the default is actually between 40 to 60%. So it's almost like a 10x passive risk. So again, my push to government will be to enhance the capacity of the risking institutions to be able to function a lot more effectively and efficiently, to be able to really give comfort to lenders and financiers and investors to really deploy capital to agriculture. Because for me, you know, capital leads to productivity gains, and productivity gains leads to competitiveness. Now, on my futures contract, I think we essentially have what it takes to have a futures contract in the market. We have a fairly deep, large grains production, so the size of the opportunity is there. We have a sophisticated financial institutions. We have banks that, and then other financial institutions that understand these asset classes. We have a viable functional commodities exchange, at least FX is functional, and we have the technology infrastructure. There is some work on the policy side that needs to be done. Securities and Exchange Commission is paying a lot of attention here to really build this. We currently have in the market about 2 central counterparties that are being licensed as we speak. And once these guys are licensed, they provide the entire market with with that form of counterparty guarantee. So, you know, whatever the market goes wrong, they stand there to make good for all the participants in the market. So we have all the recipes to make this work. We're currently knee deep in this work. We hope to start to launch the first set of derivatives contract for the market by Q1 next year, where people will be able to start to trade futures on agricultural commodities.
This is excellent, and revised, I mean, provides some hope in terms of the way we can shift things. And yeah, look forward to when this is launched. And just wondering if this is something that you can share, as you're speaking of the counterpart guarantee providers. Are those the institutions that are going to be licensed? Are they something that you can share at the moment?
Yeah, existing capital market players. So if you look at the capital market, look at the licensed exchanges, the biggest 2, that tells you the answer.
Sounds good. Yeah, okay. Thank you so much to all of our panelists. I think before I close, there is one question that have come to us from Professor Asadu from UNN, and I think this is super interesting as a question not to address. And his question is, are there agricultural risks that cannot be insured? And I'm seeing some reaction on Deji's face. But please go ahead. Is there something you wanted to say there?
No, there's almost none, right? But then the difference, it varies. So crop risk, you can do a yield index that almost take you to harvest. Credit risk of the obligor, you can have a credit guarantee that can manage that. Trade risk, you can have a trade insurance. So the product is available. The question is it accessible?
Interesting. Okay.
I'm sorry, I'll love to Unchechukwu.
Yeah, for me,
Just to add,
I think all the risks can be insured. My problem is at what cost? Well, usually sometimes the cost becomes overburdensome that it's not worth it to insure. And as far as I'm concerned, risks are evolving each and every time. No one has ever thought that there would be COVID-19 and we'll all be seated in our homes. People won't be able to move their produce to the market and people would incur losses. I don't think there is that risk that is, I don't think it has been insured as yet. And as risk evolves and risk come in, new products will have to come in. So I think it's a case of how do you insure it in a manner that provides a win-win situation for everyone. But there are, as I said, new risks come into the market, and some risks actually disappear. They cease to be risks because new methods of production come in, or some mitigation of some sort comes in to address those risks. So yeah, I believe every risk is insurable, but some might not be viable in terms of insuring.
And when you say some might not be viable, can you speak to an example that you say it's
just to add to that, Rhode,
go ahead, Uche.
Like the
I'll come back to
other two speakers said, every risk is pretty much insurable, but it's down to how much premium are you paying. And it can be so high that it does not make sense for you to insure it in the first place. What I would rather think the question should be is there a sort of agricultural risk that can more or less not be manageable? Now, there are different ways of managing them. You can either probably mitigate the risk to an extent, you can transfer it, which is this insurance we are talking about. You can avoid it or even accept it. These are all ways of managing risk. Insurance is just one of them. So it depends on the type of risk we are talking about, but there are always different ways of either managing or mitigating any of those risks that are involved with agribusinesses.
Yeah, lovely, Uche. And I think you're going in the same direction as what Kudzai had said at the beginning. And so the main question becomes at what cost and what can be easily accessible. And if we take the example of the Nigerian market today, I think I'd love to hear if there is an agro-allied operator or an agricultural producer in the panel today. What should they take away in terms of the main agricultural risk insurance products that can be accessed fairly easily on the market? Uche, feel free to reply to that, or if Kudzai has any answers, I'd love to hear
I'm not
your
sure.
thoughts.
Sorry.
So my question, yeah, so the question is, for an agricultural producer in the panel today, what should they take away with them as the main agricultural risk insurance products that they can access fairly affordably in Nigeria today?
Oh, well, in terms of managing agricultural risk, the biggest takeaway for me is in terms of looking at it from the production perspective, is being able to manage or reduce their risk by coming as groups. Yeah, because groups, whether it's horizontal or vertical, coming as groups to access credit, especially because most of the risk involved in the agribusiness has to be beyond the production risk and all that. Most of the risk has to do with credit risk and finance risk. And the only way to mitigate it is coming as a group to access these facilities, be it in commercial banks or in development banks. And there are a lot of facilities that have been made available for those agribusinesses to access these facilities within this organization.
Thanks. So, Kudzai, so Uche is saying that if people approach risk from a group perspective, it can be affordable. Do you agree with that, or do you see that there's some risk that can be much more easily insured than others?
Yeah, risks can be, it's easier to approach groups like those under an outgrower model in a certain ecosystem. It's easier to organize the farmers, and you can actually approach one person who is the aggregator. Mm-hmm. But I believe we are in the digital space and the age, and the digital age is now enabling insurance companies to reach farmers who are very remote. With the digital space, farmers can even open an insurance account, fund it, and they will be insured in other countries. So I believe it can also be done in Nigeria, especially for smallholder farmers. And by digitizing the whole space, you are actually enabling a farmer who you would not have been able to reach on a one-to-one basis to reach that farmer effectively and in a cost-effective manner. If you are going to be selling an insurance product on a farmer one-to-one, and the farmer is a smallholder farmer, it might not be profitable. But the moment you digitize it and they are able to purchase that product on a phone, you enable that. If you are able to aggregate them into a cluster or into an ecosystem, it becomes cost effective and cheaper to reach those farmers. That way, you will be able to get the farmers insured. So that's how I would put it for insurance to your question.
Sounds good. Maybe to close off with Ayodeji and working closer with the farmers today, what do you think? And what are those risks that you can much more easily insure than others?
So what is so about 2 or 3 years ago, the NICOM opened up the agricultural insurance space, and you've seen quite a lot of innovation in the last 2 years. Today, you can almost insure there are climate adapted risks. There are things like normal indemnity risk. There are things that are tied to special perils on the farm. There are things that are tied to area yield index, which says that based on this protocol and this input composition, you should get this particular yield. And if you get less than that, you start to have a trigger to pay. So production risk is a lot easier today than it was sort of like 3-4 years ago, when we only had one government-owned institutions that pretty much managed the entire agricultural insurance space. So that government being a way of business has allowed for a lot of innovation, and that's a lot easier now.
Sounds good. And I'd love to really thank all our panelists today. I'd request if others who are not speaking can go on mute because of background noises. And I just wanted to close off saying, I think we've learned quite a bit of stuff in this conversation today. And some of the closing thoughts that I go away with are the fact that when we think about the role that policy makers can play in agriculture, it can be in many ways, including land tenure system and how farmers access land titles to facilitate the access to financing, or also the access to other risk management tools. And I think the other thing that appears useful is also the fact that risk can be easier to easily approach when farmers or operators or micro enterprises approach it as a group. And that also speaks to opportunity for loans at much lower rates. And to close off, I think with the question around, can all agricultural risks be mitigated? The answer is definitely yes, but you need to look at the affordability and knowing that risk in agriculture is an evolving thing. We haven't seen all of the risks yet. COVID is one of them. It's affecting many sectors beyond agriculture, and we're yet to see what other risks might come up. On this note, I'd love to close the webinar and give the mic back to Informa Connect and for closure. Thank you, everyone.
So, Ayodeji, Kudzai, Rhode, Uche, thank you so much for a really interesting and insightful panel today. And to all our attendees, massive thank you for your time. We really hope you enjoyed it, and we hope to see you all soon. So with that, I will end the webinar. Thank you very much. Take care, and we will see you soon.
Thanks all. Bye.
Thank you. Bye-bye.